If you're a trade or construction business owner and you've ever asked yourself the question, how much should I be paying myself? Then this video is for you, because today I'm going to be breaking down the exact formula that we use to help our clients understand how much they need to be paying themselves to make sure that they're, one, making the income that they need to be making to live comfortably, and two, not damaging the health of their business because they're either paying themselves too much or too little. Owner compensation is such an important area to get right in business, yet rarely do I ever hear anyone really talking about it. That's why in this training, I'm going to be covering this topic extensively for the next half hour, so that no matter the size of your business, whether you're just starting out or about to crack 8 figures in revenue, this training will be relevant for you. For those who don't know me, my name is Troy Larkham, client advisor at Trade Business Accountants, and we help trade and construction businesses typically turning $1 to $10 million a year to build greater security in their business and dramatically increase their profits and cash. So let's dive in. So the big question here is, as the business owner, how much should you pay yourself? And it's a great question, because knowing what to pay yourself is really, really important. At the end of the day, a big reason why so many of us started a business in the first place was because we wanted to make more money than what a job could ever give us. But as much as we'd love to just make more money, the reality is what we get paid as the owners of our businesses needs to not only make sense for us, but it also needs to make sense for our businesses. You shouldn't just be paying yourself whatever you want. Now, full disclaimer, obviously, we don't know your particular situation or how your current accountant has actually set up your finances. So make sure you speak to them first before implementing anything that I'm about to discuss. Now, if you're unhappy with your current accountant or how they've got everything structured, then make sure you reach out, because we'd love to help you run a better business that makes you far more money. Now, before I can actually answer the question of how much should you pay yourself, it's important that we're on the same page with what I mean by actually paying yourself, because depending on whether or not you're a sole trader or the owner of a company, there can actually be multiple ways that you can pay yourself. As a sole trader, paying yourself is pretty simple. For tax purposes, you and your business are considered one and the same, which means you can just transfer money out of your business and into your personal account anytime you like. There's no wages or anything like that. You just take drawings. So the question of how much should you pay yourself just means how much should you draw from the business. Whereas as the owner of a company, it's not that simple. And that's because the government and the ATO no longer view your business as a single entity. They're two very distinct legal entities. So the money sitting within your business bank account is no longer your money. It's the company's money. And even as the business owner, you can't just use that company money for personal use. Again, it's not your money. It's the company's money. So freely withdrawing money from your company for personal use can actually have damaging consequences if you're not careful. I'm not saying that you can't take money out of your business. I'm just saying that you need to do it legally if you want to keep yourself out of hot water. And to keep yourself out of hot water as the owner of your company, there's really only 4 ways to legally access those company funds for personal use. And they are: 1, through a salary, a wage, or director's fees where you run yourself through payroll; 2, through a reimbursement where you take back the money you initially invested in the business to get it up and running; 3, through a Division 7A loan from your company where you're required to pay it back with interest; and 4, through a dividend where your company issues you a payment from its profits. That's it. They're the 4 ways that you can access company money for personal use. Now, it's important that moving forward, you don't confuse paying yourself a salary with paying yourself dividends from your company's profits, because there are actually 2 very distinct ways of paying yourself as the business owner. Far too often we see business owners mixing the 2, where they either don't pay themselves a salary and just live off the dividend payments from the business, or they keep their salary really low and pay themselves dividends on an as-needs basis. Either way, they're actually both flawed strategies to be paying yourself as the owner. And that's largely for one fundamental reason. You're muddying the water between getting paid for what you do versus getting a return on what you own. If you are only an employee, you work in the business and only get paid or compensated for what you do within the business. And that payment would be in the form of a wage that runs through payroll. Whereas if you are a shareholder, then you don't work in the business, so you shouldn't receive a wage. How you get compensated is through a return, because you own a percentage of the business. You're getting a return on what you own. And that return would either be in the form of a dividend payment from the profits or capital growth from the increasing value of your business, just like the growth you'd get if you invested in shares or real estate. You get rewarded or compensated through a return, not a wage. Pretty simple, right? You get a wage for what you do and you get a return on what you own. Now, I'm going to say that again because it's so important to remember moving forward. You get a wage for what you do and a return on what you own. Now, for most of you watching this training, though, you probably own your business as well as work in the business full time, likely as the director. You're technically both an employee of the business and a shareholder of the business. So it's important that you're getting compensated by the business for both these roles that you're performing, which means getting compensated through both a wage and a return. So when I say how much should you pay yourself, what I'm talking about here is actually what should your wage be? Because you need to be paying yourself a wage. You need to be getting paid for the work that you're doing in the business. And this isn't just from a perspective of principle, but also a perspective of keeping you out of hot water with the ATO. Because as of July 2021 in Australia, by law, if you're the director, you have to pay yourself a wage through payroll, just like any other employee. So that means trying to live off dividend payments alone is actually illegal by law now. You have to pay yourself a wage through payroll, which brings us back to the original question, how much should you pay yourself? Well, the answer to this question is actually probably a lot more straightforward than what many of you might think. And that is pay yourself a fair market wage. Your goal should be to pay all the employees in your business a fair market wage, including yourself. Now, there's probably a lot of you listening right now that disagree with this answer for a number of reasons, because why wouldn't you just keep your salary low and take out larger dividend payments more frequently, whether that's to try and keep taxes down or maybe conserve cash within the business? And it's a fair question, and it's actually something that we see a lot. But at Trade Business Accountants, it's our belief that this approach is actually flawed for one fundamental reason. And that is, if you're not paying yourself a fair market wage for the role that you're performing in the business, then you're exaggerating the true profitability of your business, which is distorting your business numbers and making it harder to drive improved performance and profitability within your business. Sure, your profit and loss might look good, but the numbers you're looking at aren't accurate because they're not truly reflective of actual market conditions. And what I mean by that is, for example, if you were to get hit by a bus today and your family had to replace that role that you were performing in the business and pay them what you were paying yourself right now, would it be enough? Or if you wanted to sell and exit the business, would the wage that you're paying yourself right now be enough to easily and comfortably bring someone in to fulfill that role? If the answer is yes, fantastic. Chances are you're paying yourself a fair market wage. But if the answer is no, then chances are you're underpaying yourself, distorting your numbers, and exaggerating the true profitability of your business. So sure, it might feel good to have a fatter profit margin, but it doesn't take away from the fact that the numbers you're looking at are actually lying to you. For example, let's say you're running a business with $1 million turnover. And over the past year, you've spent $600,000 in your cost of goods sold or your job costs like labor, materials, and subcontractors and stuff like that. And then on top of that, you spent $300,000 in your overhead costs or your operating costs to cover those business operational expenses like rent, subscriptions, ICT, accounting, legal, insurance, and other overhead costs like that. At the end of the day, this leaves you with $100,000 in operating profit, which is an operating profit of 10%. Now, you'd probably be pretty happy about that because it's not a bad effort. Most businesses never achieve an operating profit margin of 10% ever. So in that case, it looks like you actually know a thing or two about business. But there's a problem. It turns out you're only paying yourself a $30,000 salary and taking dividends out on an as-needs basis on top of that, which is far from a fair market wage of someone running $1 million operation. Realistically, you should be getting paid upwards of $100,000 as a fair market wage. So this means that you're not actually achieving a 10% operating profit margin or $100,000 in operating profit, because we need to factor in that extra $70,000 in your overhead costs. Because again, if you were to get hit by a bus and needed to get replaced, is someone going to fill that role on a $30,000 salary? Chances are they're not. They'd expect no less than $100,000 per year as a salary. So once we actually factor in that $70K on top of the $30K salary that you were paying yourself, you're actually only making $30,000 in operating profit or a 3% operating profit margin, which makes your performance for the year look much, much worse. And the reality is $30K operating profit for $1 million business just isn't enough. You're barely breaking even from a profit perspective, and chances are your cash flow looks a hell of a lot worse. And to make matters worse, even though you're in this dire situation, because your distorted profit and loss is telling you that everything's fine, you just keep operating the way that you already are, thinking you're doing a great job, when in reality you're not, and you really should be getting your ass into gear and starting to fix your profit problem. This is why accurate, undistorted numbers are critical. Without them, it makes it really difficult to drive improved performance and profitability within your business, because you're not getting the data you need in the first place to be able to actually make well-informed strategic decisions to improve the performance and profitability of it, which should be your number one priority. If you don't get compensation right, you're going to make it harder for yourself to put points on the board. And that's because until you're paying yourself a fair market wage, you really have no clue on the health of how your business is actually performing. Your numbers are lying to you, and you've got financial reports that are about as useful as a compass that's 10 degrees off. And you'll likely end up continuing down the path of false profits, poor wages, and a business that never really creates the lifestyle that you'd hoped for in the beginning. The solution to correct this distortion is to start paying yourself a fair market wage. Now, obviously, that distortion does decrease the larger you get because your wage as a percentage of the business's revenue shrinks the larger your business grows. But if you're turning less than $5 million a year in revenue and you aren't paying yourself a fair market wage, then the impact is far greater. Now, I know some of you might have specific owner compensation setups for tax purposes, and I get it. We all want to reduce the amount of tax we pay, but remember what I just spoke about. Driving improved performance and profitability within your business should be your number one priority. So by having an owner compensation structured purely for tax purposes, you are implicating your ability to improve the performance and profitability of your business. If there's one thing that I've learned working in the business and accounting world, it's that people get way too hung up on the expense side of the equation, particularly when it comes to reducing tax. Don't get me wrong, you shouldn't be paying any more than your fair share, and we'll always advise our clients to be wary of expenditure. But at the end of the day, expenses are and always will be second in importance to making more money. So if your sole focus on underpaying yourself is from a pure tax perspective, then it's my belief that you're focusing on the wrong side of the equation. Your tax strategies should not implicate your ability to improve the performance and profitability of your business. At the end of the day, tax is just a part of business. The sooner you can accept that, the sooner you can start focusing on the right side of the equation and making more money for yourself over the short and long term. All right, so I've covered quite a bit here in the first half of this training. I hope you've got plenty out of it. But to really drive home everything I've spoken about up until this point, I really want to give you two challenges that will ensure you start to pay yourself a fair market wage. The first challenge is to be a more demanding employee. No employee would ever accept a wage of $30,000 if they're performing a role in the business that's worth $100,000 or maybe even $120,000 a year. So why are you willing to work for such a low salary? Be a more demanding employee and expect to get compensated fairly for the role that you're performing in the business. The second challenge is to be a more demanding shareholder. Because as a demanding shareholder, if the business that you own can't turn a decent profit after paying everyone in the business a fair market wage, then you'd be looking to see some big changes happening. You'd want to be seeing a decent return from your investment. Otherwise, what's the point? Why would you remain a shareholder of a business that gives you little to no return? That's why, as a demanding shareholder, you need to push the company into profitability. Because if your business can't turn a profit, then you shouldn't be rewarded with a return on what you own. It's that simple. So again, be a more demanding employee and be a more demanding shareholder. Now, I won't go too much deeper into that because I spoke about it extensively on the last training I did called When You Should Pull Money Out of Your Trade and Construction Business, where I break down our 7-point checklist that you need to follow before paying yourself a dividend. So make sure you go check that out. But to summarize this point, a healthy business pays everyone a fair market wage and gives the owners a fair return at the end of the day. Your business should be able to pay you what you're entitled from both sides of the equation. If it can't, then there are very real problems in your business that need addressing. Okay, so at this point, you know you need to pay yourself a fair market wage, but you're probably thinking, what's the fair market wage for the role that I'm performing in my business? Well, the best way to answer this question is by asking you the same question I actually asked you earlier. And that is, if you got run over by a bus today and your family or management team decided they would keep the business going in your absence, what would they have to pay someone to do your job? What would they have to pay someone to fulfill that role and commit to doing the workload and the job that you're doing day to day? Now, obviously, the answer to this question is going to vary significantly based on the size of your operation and the role that you actually play within it. For example, if you're a one-man band, you're going to be on the tools 100%. So your wage might only be $90,000 or $100,000 per year because that's the wage of a good tradesman. Whereas if you're operating more of a managing director capacity with maybe a team of 10, where you're 100% off the tools, managing the business and also focusing on sales and client relations, then your wage might range from $120,000 to $150,000, which is going to be more appropriate for that role. And on an even higher level, if you're operating more of a CEO capacity with maybe a team of 30, then your wage is going to be more appropriate for that role and the size of that business, which might be, for example, $200,000 to $300,000 per year. Again, it all depends on what the market is willing to pay for the role that you're performing. Now, if you want to get super specific with what your salary should be, there are plenty of salary survey sites out there that break down salaries for specific roles, or you can even ask industry peers what they think too if you're not really sure. Now, on a side note, it's also important that you try to set your wage to a point that it can comfortably pay for your personal life. That way, you can strive to use any dividend payments to build your personal wealth outside of the business. Now, of course, sometimes that might not be possible given certain circumstances, and maybe you'll need your dividends to fund certain aspects of your personal life. But as a general rule, try your best to live strictly on a fair market wage, even if that means living more within your means. So you're able to build your personal wealth outside of the business, which can be a really, really powerful strategy. Now, when it comes to figuring out fair market wages, a common scenario that we stumble across in this industry is when 2 or 3 people decide to go into business together, whether they're mates or former work colleagues. And here they typically split the ownership of the company evenly between all of them. And that's great. That's totally fine. But where they go wrong is they also end up paying all the owners the exact same wage as well. Now, this might seem like the fair way of doing things for all parties involved, but it's my belief that this is actually a flawed way of achieving fair, because fair does not mean equal. Fair would mean everyone getting paid the appropriate salary for the role that they play in the business. They're fair market wages. Yes, you all have equal ownership of the company, and that's great. You're all equal shareholders, but remember that you have 2 roles to play. There's the employee side of the equation and the shareholder side of the equation. And that's why you've got to look at the owner compensation of all the owners through both those lenses. The return they should get on the business and the wage they should get in the business. Again, they are both clearly distinct roles within the business. The best way to drive this point home is to compare the extremes. Is if you had one shareholder who pretty much ran the entire operation and another shareholder who did nothing in it, would you expect them to both earn the exact same salary? Of course not. That wouldn't be fair at all. Well, the same goes for the lesser extremes as well. If one of the owners is acting as the managing director and another is just working as a tradesman on site, then they should both be earning different wages. It's totally fair that they might have equal ownership of the company and equal shareholdings, but when it comes to the wages and the perspective of what they're doing within the business, the role they're performing within the business, paying them both the same salary just isn't fair. And it's not logical either. If we tie back to what I was talking about earlier, if you're paying someone who's performing a tradesman role the same as what you'd pay the managing director, then you're distorting your numbers again. They're not truly reflective of actual market conditions, because a tradesman would never get paid that much money. They're performing entirely different roles that have a different market-based value and therefore different market-based wages. Rarely are 2 roles within the business worth the exact same salary, let alone 3. Now, typically the managing director should have the highest salary in the business. There's actually only really 2 positions that might get a higher salary. And they are 1, a salesperson who's on an eat what you kill incentive program, and 2, a technical expert who gets a high salary at the early stage of the business when you have to build the whole business off that one person's technical skill set. When you have just one technical person who's the expert and they aren't the managing director, well, the business isn't probably in a healthy enough position to be able to pay the managing director more than the expert. But once you have multiple experts on staff and support people, the managing director has a much larger business and can justify the larger salary. Now, this naturally opens up another discussion on a huge mistake that so many multi-shareholder companies make, and that is 2 or 3 owners all trying to be the managing director. You shouldn't have 2 or 3 people playing the managing director role. It just isn't feasible. You all need to be playing specific roles within the business depending on your unique skill sets and strengths. For example, one of you might be a technical expert, so maybe a supervisory role out in the field would be more appropriate. And another might be great at building rapport, kicking the dirt with customers, as well as running the operations. So a sales and managing director role might be more appropriate for them. Make the call based on each owner's strengths and what they can bring to the table. You shouldn't put everyone in the same position and pay everyone the same salary for the same role. In my belief, it just isn't realistic and you're distorting your data. Now, I'm not saying you shouldn't pay all the owners the same wage, because maybe the fair market wage for each owner's individual role is the same, which can happen. What I am saying is each owner should be playing a specific role within the company and getting compensated fairly based on that role, rather than 2 or 3 people performing the exact same role and all getting paid the same amount. This ensures everything is fair and you're not distorting your numbers. So sit down, drop the egos, and have an upfront, open and honest conversation about this. This isn't about you. This isn't about your ego. This is about prioritizing the business and making the best decisions for the business. And this shouldn't be a subjective discussion either. A fair market wage is a fair market wage. If you get clear on the specific roles you're supposed to perform and the expectations of these roles, then getting clear on an appropriate salary should be relatively easy. Now, in saying that though, if you're the only one out of all the owners who's watched this training, then I strongly recommend you get the others to watch it as well. So everyone's on the same page and it reduces the likelihood of dispute. If you just go to them with this right now and you happen to be the one sitting on the top, you're probably going to be opening yourself up to copping a bit of flack. So again, make sure everyone's on the same page. But at the end of the day, the people who have this discussion up front are the ones who succeed. You may want to answer salary and leadership questions over a period of time, but within a couple of years, you need to make these tough decisions. The success of your business depends on it. All right. So at this point, you're likely going to be thinking one of three things. Now, one, I'm going to start paying myself a fair market wage so my financials reflect the true profitability of my business, allowing me to improve and drive performance, which is fantastic. Two, I'm going to continue paying myself a below market wage. If that's the case, I recommend go back and listen to this training from the start because it's clear that what I've said hasn't drilled in deep enough. So again, go back and watch from the top. Or finally, three, my business can't afford to pay me a fair market wage. Now, this might be some of you listening, especially those just starting out. You might be in a position where your business just isn't going to be in a position to be able to financially support paying you a fair market wage for the role that you're actually currently performing in the business. For example, if you're a startup within your first 1 or 2 years and you've been trying to figure this whole business thing out, then there's a good chance you're probably not in a position to pay yourself a market-based wage. And that's perfectly fine. But the reality of the situation is you don't want to be in that period for too much longer. Because at the end of the day, if you can't pay yourself a fair market wage through the finances of your own business and your own funding, then you're operating at a loss in the real world. And to put simply, your business is sick. If this is the case for you, I strongly recommend you go and watch our cash flow masterclass training that we've provided for free on our channel, because in that training, we provide a super simple framework that you can use to start flooding your business with more cash today. And that's going to be super helpful if you're struggling to get the money through the door to be able to actually pay yourself a fair market wage. Until you can pay yourself a fair market wage and make a profit on top of that, then you will continue to have a sick business on your hands. Yes, your profit and loss might be showing that you're technically making a few $1,000s per month. But if you remember what I was saying earlier, this is false profit because you're not paying yourself a fair market wage. And therefore, your business isn't truly representative of actual market conditions. So again, you can't let this phase go on for too long. Otherwise, you're always going to face one really, really bad scenario. And that is a consistent below market wage and no return on your investment. Now, in the meantime, while you're building yourself to that point, there's a different way to actually pay yourself what you're worth without taking cash out of the business. And that way is called sweat equity, a term coined by Greg Crabtree. Now, to put simply, sweat equity is the capital that you create for your business through unpaid work. For example, if you've been running a business for 2 years that should have realistically been paying you a $100,000 salary for the role that you're performing in it, that means over the past 2 years, you should have been paid $200,000. That's your fair market-based salary over the past 2 years. However, because you only started your business 2 years ago, you probably weren't able to pay yourself that $100,000 salary. Your business just couldn't afford it. So instead, you decided to pay yourself a $50,000 salary, which over the 2-year period totals around $100,000 that's been paid to you. That means there's $100,000 in fair market salary payments outstanding that is still owed to you. That's the $200,000 that should have been paid minus the $100,000 that actually got paid. But rather than take that $100,000 out, you decide to keep it in the business. Well, that means you've just created $100,000 in capital for the business through sweat equity. This is because you kept that money in the business rather than pulling it out to pay yourself a wage. And this is something that's super, super powerful, especially in the early days of business. And it's an important concept to understand because it lets you calculate your lost opportunity to earn a fair market wage had you chosen to go elsewhere. And it becomes even more important once you start diving into the complexities of multiple owners with different salaries or outside investors, because sweat equity is your way of ensuring you end up with ownership over that sweat equity capital that you kept in the business rather than it being unfairly distributed to all the other shareholders of the business. Now, that whole discussion can get quite complex and it needs to be considered based off your unique circumstances. So make sure you reach out because we'd love to help. But as an overarching takeaway, just make sure you're tracking your sweat equity. Because when it comes to building capital in your business, there's only 2 currencies that matter: money and effort. Sweat equity is simply your way of measuring effort against money and getting them to play nice. So if you can't pay yourself a wage right now, Keep track of the wages that you're giving up. This is money that is owned by you. It's your investment in the business. So you want to make damn sure that it stays that way and that you continue to get a return from it long into the future. Now, if you're going to invest sweat equity in the business, it should only be a short-term strategy of 2 to 3 years at max. This is because a common pitfall that we find trade and construction business owners regularly falling in is when they get complacent with sweat equity and don't plan a roadmap out for themselves to start earning a fair market wage. And in the end, they get stuck in the sweat equity sinkhole for 5, 10, 20 years and beyond, never really achieving a full fair market wage. But I strongly believe that if you can't pay yourself a fair market wage within 2 to 3 years of starting your business, then it's likely something is not right with your model. And again, I recommend watching our cash flow masterclass training if that is the case for you. But as a key takeaway, just make sure you have a game plan to get yourself to a point where your business can actually afford to pay you a fair market wage. And that's a real salary running through payroll, not a dividend payment from your profits. Again, like I said earlier, you need to try your best to not live off dividend payments. It's my belief that it's far better to live off your savings account and a below market wage while your sweat equity builds a cash cushion in your business than it is to fall into the trap that most trade business owners find themselves in when they start out, which is paying themselves a below market wage and living off the profits of the business. Living on your savings account and a below market wage will ensure you don't get complacent, and it will ensure that you kick your ass into gear rather than getting stuck in the sweat equity sinkhole for 5+ years. Dipping into your profits early on only delays your success because it gives you a false sense of security that everything is all right when it's not, which is a dangerous, dangerous path to go down. So again, if you're in your early days of business, make sure you get a plan in place to know when you're going to start paying yourself a fair market wage. It's super, super critical so you don't end up in that sinkhole that so many trade business owners find themselves in. All right, so that's everything I wanted to cover in today's training. I hope it gave you plenty of insight into how much you should really be paying yourself as the owner of your business. And if your business can't afford to pay that amount, the steps needed to turn your business around so it can start to pay you a fair market wage. If you have any feedback or questions, please let me know in the comments below. Also, remember to like and subscribe if you haven't already. If you'd like any help when it comes to everything we've just covered and making more money in your business, then feel free to book in a call with our team using the link in the description below. And until I see you again in the next video, keep getting after it.